Hi, Mark Homer here from Progressive. I've just finished a conference with the top economist at Lloyds Banking Group, and he's been with the Bank of England today listening to what their changes have been in terms of interest rates, corporate and government bonds, and a new term lending facility. So what's happened? Well, it's been a big day in finance today. Interest rates have been dropped to 0.25% today. That is the lowest ever rate and the first rate cut for 7 years. It was a unanimous decision by the Bank of England Monetary Policy Committee. All 9 members voted for it. It gives you an idea of the economic headwinds which they feel we're probably going to face as this year continues. So what else have they decided? Well, they're going to continue with their quantitative easing programme, which means they're going to continue buying government bonds, about 60 billion's worth. But there's a new addition this time. They're going to buy about £10 billion worth of corporate bonds. Now, corporate bonds are loans which companies get from other companies and other individuals. And what this really means is there is new money going into the economy, and the Bank of England are looking for that money to find its way. And what these bond purchases really mean is the Bank of England are putting money into the private sector, which they hope will finance spending to keep the economy moving. So the big news for us as property investors is there's going to be a new term lending scheme. It's effectively a derivative of the old funding for lending scheme. You probably remember where the Bank of England allowed banks to come along and borrow money from them very, very cheaply, as long as they then lent that out to businesses in the wider economy. And this new scheme effectively means that the big banks can go and borrow money at just over 0.25%, which is so cheap. And they've got to then pile that out at a really low rate to their borrowers, to other companies, to us, to investors. And if they don't, they're going to have to pay a penalty. So we should start seeing a double whammy effect now of interest rates reducing, A, because base rate is reduced, but also the margin between base rate and the amount that the bank actually charges should start to reduce. So we should start to see our mortgages for our investment purchases reduce even further, which I find really exciting because it's going to give us more margin and more cash. What next for interest rates? Well, if nothing else changes, the Bank of England have said when they next meet on the 3rd of November, they're actually going to cut interest rates again. So they're going to cut them to just slightly above zero. They've said they've no appetite for negative rates. So I know the newspapers have been talking a little bit about reducing interest rates to below zero, as they have in Japan and other countries. But that doesn't look like that's on the cards at the moment. But another interest rate cut towards the end of the year, even if there aren't any other surprises, that's what they're talking about doing. So what's likely to happen to inflation? Well, obviously imports have got more expensive because the pound has devalued against the dollar and less so against the euro. And if you think of an average kind of basket of goods, if you go to Tesco's, about 30% of the average kind of consumer basket of goods consists of imports. And because about a third consists of imports and sterling has weakened by about 10%, we're probably going to see a rise in inflation of about 3%. That's probably going to take at least a year to start feeding through. And you might say, well, doesn't that mean that interest rates will start rising because they need to control inflation? Now, it could do later on, but we're at a kind of weird juncture, and effectively they want to stabilise output. So output concerns trump inflation concerns. So at the moment, they're trying to get output increased again and effectively offset this uncertainty that is going around the economy, so that things keep moving towards the end of this year and into next year. Growth's probably going to be flat for the rest of the year. So rates are on their way down. Probably go back to your lenders, see if you can reevaluate the marketplace. Certainly with the commercial lenders, they should be cheaper. Buy-to-let lenders should be reducing their rates. I think it's a great time to be buying because your cash flow should be going up. I hope you found that useful. I've certainly enjoyed delivering it. If you've got any further questions, just send me an email at markhomer@progressiveproperty.co.uk.